Welcome to today's program titled Guidance on State and Local Paid Family Leave Laws, Part 11, Staying Ahead of 2025 Changes and Preparing for 2026. At this time, all participants are in a listen-only mode. For those of you who are logged in to the live web presentation, you are encouraged to submit questions throughout the conference by typing them into the Q&A box on the right-hand side of your screen. For those interested in obtaining CLE credit for this webinar, later in the presentation, we will read the CLE attendance verification code. Please write this code down, as it will not be reread, and it is required on the CLE credit request form. During the program, you will see a slide with a QR code that you may scan to access and submit your request for CLE credit. You can also find a link to that form in the connection details email you received this morning. Copies of the webinar recording and materials will be distributed to all attendees within a day or two following the webinar. On the next slide, you will see a legal disclaimer. And at this time, I would like to turn it over to our first speaker for today's program, Josh Seidman. Josh, please go ahead.
Hey, Kate. Hi, everyone. Happy middle of December. Happy early holidays to folks. Really excited to be here with you today for the first of our two paid leave webinars that are taking place this week. We're starting off today with paid family medical leave. Lots of activity. We have a great team here with you to go through all of the updates. And joining me are my colleagues Ashley, Renata, and Jean. I'm Josh Seidman. It is wonderful to be with you all. Next slide, please. So here's our agenda for today's presentation. We're going to start you off with just a very quick national overview and then dive into several spotlighted jurisdictions. We'll start off with Minnesota, then turn to Delaware and Maine, followed by Rhode Island, Colorado, and Washington, all of which have had amendments to their respective paid family medical leave programs that are starting the beginning of the new year. And then we'll also do some forecasting at the state and federal levels looking ahead to 2026. Next slide, please. So for our nationwide overview, we're going to, you've probably seen this slide a few different times if you've joined us for earlier segments of our webinar series. If you go to the next slide, though, we'll give you the lay of the land. We always like starting off with this overview because it really sets the table for a patchwork of laws that continues to evolve and change and is constantly in flux, even when a program has been in place for a number of years, like, say, the Washington State program. It still keeps employers on their toes because of amendments to the program, updated FAQs, updated forms, and whatnot. The landscape today consists of more than one type of law. So when we say paid family leave, it is not only paid family leave, it is paid family leave, paid family medical leave, paid family medical leave mandates versus voluntary programs. You can see that there are two states with voluntary programs, New Hampshire and Vermont, that are listed on this slide. You also have states with statutory disability insurance benefits, as well as states that have family leave as a class of insurance. So lots of nuances when you peek underneath that first layer, the overarching concept of what paid family leave laws are. So what is the landscape today? Well, we have 14 states plus Washington, D.C. Again, we're going to be spotlighting 6 of those states over the next several minutes. One municipality in San Francisco, which has a paid parental leave ordinance that stacks on top of California's paid family leave program. As we mentioned a second ago, there are paid family leave laws in 4 places, California, New York, New Jersey, and Rhode Island. They don't have a medical component to their programs, but they do have statutory disability insurance laws to fill that void. And those laws have been around for decades, as has the Hawaii statutory disability insurance program. As sort of a spoiler, Hawaii might be one of the places that we are going to be forecasting and zooming in on as a potential 2026 activity jurisdiction. So stay tuned for the end for that nugget. With that, I'm going to turn it over to Ashley to start us off with our state-specific discussion, and that's going to be in the state of Minnesota.
Okay, perfect. So I'll kick us off with an update on Minnesota's paid leave law. So on the next slide, we'll start with some important milestones. So the Minnesota paid leave law was signed by the governor a little more than 2.5 years ago at this point on May 25th, 2023. And since then, there have been several amendments to the law, which we'll go over in the next few slides. But in terms of deadlines, employers were required to submit their first quarterly wage report a little more than a year ago on October 31st, 2024. And as a reminder, the Minnesota paid leave law has a mandatory notice requirement, which was required to be distributed to all employees eligible for paid leave by December 1st, 2025. So if you haven't done so already, we strongly recommend that you distribute the notice as soon as possible. And to help with this, the Minnesota paid leave website has a helpful model notice, which you can go ahead and download, customize, and then distribute to your Minnesota employees. And this can be done either personally or through some electronic format, such as email. We'll get into that a little bit later. And looking forward, employee payroll deductions will begin in a few weeks on January 1st, 2026. And this is a little bit unique because Minnesota did not collect employee contributions before employees can go ahead and begin using paid leave under the law, unlike a lot of other states, which you'll hear about today. So both go into effect on January 1st, 2026. And finally, employers' first quarterly premiums are due by April 30th, 2026. So on the next slide, we'll get into the definitions of employee and employer under the paid leave law. So the law has a broad definition of employee because employees may be covered by the law even if they don't work in Minnesota 50% or more of the time. So along with those who work in Minnesota full-time, employees will be entitled to paid leave if they work in Minnesota less than 50% of the time, but they live in Minnesota more than half of the year. So this is important to know in case you have mobile employees who frequently travel between states, just something to be aware of. However, the term employee does not include self-employed individuals, independent contractors, or certain seasonal employees. And those are employees who work in the hospitality industry for no more than 150 days in the calendar year. In terms of the definition of employer, that's also broad. So this is going to include all employers who employ one or more employees except the government. On the next slide, we'll go into the covered reasons for use. So in terms of reasons for use, covered employees can use Minnesota paid leave for several different reasons. This includes things like bonding with a new child, caring for a family member with a serious health condition, needs arising out of a military member's active duty, for reasons related to domestic abuse, sexual assault, or stalking, care of the employee's own serious health condition, and any medical needs relating to pregnancy or pregnancy loss. So again, pretty broad there. Moving on to covered family members, employees can use Minnesota paid leave for all family members that you would probably expect, like a spouse, child, parent, etc. But there's a few unique covered family members that are worth highlighting here. That includes a son or daughter-in-law, and anyone that the employee has a personal relationship with that creates an expectation or reliance that the employee will care for that person without compensation. And this is important because the employee does not need to live with this individual for them to be considered a covered family member under the law. So moving on to the amount of leave, this is a topic that we get a decent amount of questions about. So under the paid leave law, employees can use a maximum of 12 weeks of paid family leave or 12 weeks of medical leave in a single benefit year. But if they qualify for both medical and family leave in a single benefit year, for example, if they need to care for a covered family member with a serious health condition, but they also need leave to bond with a newborn child in the same benefit year, they can take a total of 20 weeks combined of both family and medical leave. So it's either or. And for purposes of Minnesota paid leave, benefit year refers to the 12-month period, which starts when the employee first takes paid leave. And also here you'll see that Minnesota paid leave can be taken on a continuous or intermittent basis. So a few notes about intermittent leave. Employees can opt to take at least 480 hours of intermittent leave in a benefit year, which is about 12 weeks of paid leave at a 40-hour per week ratio, and when employees are using intermittent leave, they'll be paid for the time actually taken off from work for a qualifying reason. And on the next slide, we'll stick with the topic of pay for now. So Minnesota paid leave law includes a formula employers can use to determine an employee's pay while using paid leave, which is here on the screen. But for January 1st, 2026, the maximum weekly benefit is $1,423. So also on this topic, paid leave benefits will be paid to employees on a weekly basis, and they'll receive their payments directly from the state of Minnesota. And on the next slide, you'll see that the Minnesota paid leave program is funded through employee payroll deductions and employer contributions if the employer so chooses. So what this means is that employers can choose to split the cost with their employees or pay a larger portion of the cost if they choose to do so. Or if employers are feeling extra generous, they can cover the full cost of employees' premiums. But in any event, employees cannot be asked to pay more than 50% of the annual premiums, which is 0.44% of their wages. And also something just to know for 2026, the paid leave law has different premium rates for both small and large employers. So small employers are those with 30 or fewer employees in each calendar quarter, and they meet certain employee wage requirements. But the premium rate for small employers is currently 0.66%, and the premium rate for large employers is 0.88%. Next slide, please. In addition, employers can opt to use a private plan as opposed to the state plan, as long as the benefits are equal to or greater than those benefits required under the paid leave law. So this means that all the requirements that we just went over in terms of eligible employees, reasons for use, amount of leave pay, all of those things, they must be the same or more favorable to employees. And please note that if you're using a private plan or you want to use a private plan, as of the law's effective date, which is January 1st, 2026, your private plan must have been received by November 15th, 2025. So if you plan to use a private plan and have not already applied, it's important that you apply as soon as possible. And you can do this through your paid leave administrator account, which is on the Minnesota paid leave website. Because for requests submitted after November 15, 2025, the earliest that your private plan will take effect is April 1st, 2026. And in case you're looking for an approved private plan, the Minnesota Department of Commerce published a helpful list on their paid leave website of different approved private plans, and it looks like they're regularly updating this in case that's helpful for you. And on the next slide, we'll talk about a few notice and posting requirements. So we already briefly discussed the paid leave notice requirement earlier, but just to reiterate, the deadline for this notice was November 1st, 2025. In terms of employee acknowledgement, the law requires that employees acknowledge receipt of the notice. If the employee refuses to acknowledge receipt, the employer just needs to demonstrate that the employee was actually notified. And that can be done through proof of the email or other means of distribution. Previously, the law had a requirement that a written statement from the employee was required, which would confirm their refusal to acknowledge receipt, but this was removed in the law's latest amendment, so no need to worry about that anymore. There's also a separate posting requirement that you should be mindful of. So Minnesota published a sample poster on its paid leave website, which again, you can download and post. If at least 5% of your workforce speaks a language other than English, please post the poster in English as well as that other language, just to fully comply with the law. And finally, there's also an earning statement notification requirement. So any amount deducted, like employee payroll deductions, should also be included on an employee's pay statement. And with that, I will pass it over to Josh to go over Delaware.
Awesome. Thank you, Ashley. Hi again, everyone. So we're going to jump right in. A lot of ground to cover with Delaware, just like with Minnesota. The Delaware Paid Family Leave Program benefits go live in a matter of weeks. So let's jump in. Next slide, please. Oh, perfect. So when we're looking at the this first cover slide, this slide and then the next two are meant to give some background for folks. There is, you'll see on this slide and the next two, some spots with red font with double asterisks added. That is meant to indicate specific topics that have been impacted by the amended Delaware Paid Family Medical Leave regulations that were signed and went into effect earlier this month. So 11th hour and 57th minute or so. And they're impactful. It is not just tinkering around the edges. Some of the changes, as we'll talk about in a few slides from now, are very significant in terms of employers and their go forward, as well as what they've already likely programmed and put together in terms of policies. So overview, though, before we get there. The Delaware Paid Family Medical Leave law does not apply to every employer in Delaware. You have to have 10 or more employees working in Delaware. And if you have between 10 and 24 employees, only the parental leave part of the program applies. From an employee eligibility perspective, the standards very closely track, not exactly, but very closely track the FMLA standards, specifically on the length of time and the number of hours worked. It is 12 months of employment and 1,250 hours worked in the prior 12 months in order to be an eligible employee. You also need to be primarily working in, you have to be primarily in Delaware. We'll talk about how that concept of what primarily means has changed from these amended regulations that came out a couple of weeks ago. Reasons for use and covered family members, again, very much tracking the federal FMLA. You can use Delaware paid family medical leave for parental leave to bond with a new child within the first year following the bonding event, for medical leave for the employee's own serious health condition, for family caregiving to care for a family member who has a serious health condition, and for qualifying military exigency. The military exigency piece, as well as the caregiving and medical leave, you can see for all of those, again, tracking what the federal FMLA brings to the table. For medical and caregiving, they use the same definition of serious health condition as under the federal law. And the family member definition also is the same as under the federal FMLA. Next slide, please. This first row on this next slide, the amount of leave, is where there is a very significant divergence between Delaware paid family leave and the federal FMLA. Delaware paid family medical leave starts off tracking the FMLA, the maximum aggregate amount of total all types of leave that you can use in an application year is 12 weeks. But then you zoom in on medical leave, family caregiving leave, and qualifying exigency leave. And for each of those discrete buckets, there are 6 weeks in a 24-month period that's available. And whether those 6 weeks are cumulative across those three types or separate between them, as well as how you define 24-month period and how you define application year, all of those topics have been impacted by the recently issued amended regulations. Parental leave is available for 12 weeks in an application year, but piecing all of this together, especially the medical and the caregiving and the exigency, when you're thinking about overlap with the FMLA, it is very possible that especially during those months 13 to 24 of those 24-month periods, you could wind up having an employee take FMLA leave that would be covered for the medical piece or the exigency piece or the caregiving piece under Delaware's law, but for the employee having already exhausted those 6 weeks during the first 12-month cycle, the first 12 months of that 24-month period. So there's going to be some decent stacking going on in real time when these benefits go live, fast forwarding to 2027, 2028, and whatnot. You can see the amount of pay and the employee contributions. The amount of pay on this slide maxes out at $900 per week. That'll be both for 2026 and 2027. From an employee contribution perspective, the employer can split the cost of the program 50-50 with their employees, or they can elect to cover a greater portion of the employee's contributions if they so choose. Next slide, please. So in terms of our timeline, important dates, how things have evolved and unfolded in Delaware, a lot of activity has already taken place. But to recap, especially for 2025 purposes, at the beginning of this year, and unlike what Ashley described in Minnesota, payroll deductions began a year ahead of time before the benefit go live date in Delaware. So for a lot of employers, payroll deductions began at the start of this year. The first quarterly contributions were due, the remitting back to the state or to the carrier were due on April 30th of this year, and then the end of July and the end of October and so forth. The October 1 to December 1, 2025 period was the time frame for employers who had already opted into the private plan and gotten approval for the private plan alternative instead of using the state public plan to renew those private plans. However, that time period, that renewal process has also changed from these amended regulations, which there they are on the slide, on the timeline, December 2025, the regs were amended, and not a moment too soon because the benefits start in just a matter of days on January 1, 2026. Next slide, please. Okay, so I will not drum roll, but imagine a drum roll if you are listening and following along here, because I've mentioned the December 2025 amended regulations at least a dozen times so far, and here they are. So let's talk through what actually has changed, because it is a lot and it's impactful. First, and potentially most importantly, the application year standard has changed. So under the statute, application year is defined as the 12-month period as defined in the federal FMLA. Calendar year, fixed 12-month period like fiscal year, the look forward 12-month period, or the rolling look backwards 12-month period. All on the table, reinforced by the old regulations. But under the amended regs that came out a couple of weeks ago, the application year shall be the 12-month look forward period. That means the 12-month period beginning on the first day that the employee takes Delaware PFML, and it continues for the next 12 months. That is the standard that must be used by all employers. So if you are an employer who has already done the legwork to program your systems, to coordinate your benefits, to train your teams, to coordinate with your FMLA practices, and your practices were in Delaware to use any 12-month period other than the look forward option, that is no longer allowed. That will not be allowed heading into the new year. So that is a big complication for employers who have to go back to revamp their programming, redo their policies and the like. And when you're going to be coordinating with the FMLA in the new year and in 2027 and beyond, that is going to be a complicated set of coordination already stacked on top of complicated coordination because of that next bullet point, which is that 24-month period that I mentioned a few slides ago. The law no longer allows for flexibility in terms of how you define the 24-month period. It is a 24-month look forward period beginning on the first day of the requested leave for that benefit type. So you'll remember that it is the medical, the family caregiving, and the qualifying exigency that are measured over 6 weeks in a 24-month period. It now appears that there is going to be a separate, or could be at least, a separate 24-month period for each of those benefit types that need to be tracked and administered in conjunction with other company provided benefits, your FMLA obligations, parental leave under the Delaware program, and that 12-month aggregate application year. So very, very clunky. We've been fielding calls and emails from clients trying to figure out what this means for their policies and practices in reality. So if this is something that you have not been paying attention to since these amended regs dropped a couple of weeks ago, it is worth dusting off whatever your programming and policies are and making sure you have this piece buttoned up. Next slide, please. But wait, there's more. The Delaware amended regs also impacted several other important topics. One of them, employee eligibility. So the 1 year and the 1250 hours, those are still in play. But that primarily definition, right? You have to be primarily reporting for work in Delaware. If you are not, then you're not going to be eligible for Delaware paid family medical leave. Primarily used to be tied to working in Delaware for at least 60% of the employee's work hours. So if you're physically in Delaware for 60% of your work time in a calendar quarter, you're going to be covered, assuming you work the hours and have been employed for a year. That standard has now been rejiggered a bit to focus on earnings. If you have earned at least 60% of your wages while physically working in Delaware, each calendar quarter, you will be considered eligible, right? Or at least satisfying the primarily part of the eligibility standards. In terms of coordination and benefits with time off, PTO, vacation, sick time, and the like, previously, employers had the ability to mandate that workers could use up to 75% of their earned and used paid time off before accessing Delaware paid family medical leave. No longer the case. Now, employers cannot require unilaterally that employees use any of their paid time off before touching their Delaware paid family medical leave entitlement. You can mutually agree with the worker to allow the worker to use available paid time off or vacation or sick days to top up your Delaware paid family leave entitlement. But that agreement needs to be in writing and it needs to be signed by the worker and the employer. So extra administrative red tape that the employer would need to go through if they want to allow this top-off practice to take place. When it comes to coordination with leaves, right? So employer short-term, long-term disability, parental leave, and the like, there previously had been how do you figure out who the primary, secondary payer is? It was tied to the terms of the disability or the paid leave policy of the employer. That is no longer the case. Delaware PFML will be the primary payer going forward. Also, there had been an obligation for employers to provide notice of coordination of benefits to their employees, notice of how your PTO and Delaware PFML would be coordinated and run concurrent and whatnot. That notice obligation has been removed from the regulation. So that is, of all the things I've kind of mentioned here, maybe the first pro-employer takeaway of these different topics. Finally, when we're looking at private plan applications, I previewed this a few minutes ago. For private plan applications and renewals, the application process has changed and the renewal process has changed. It is no longer going to be that fixed 10-1 to 12-1 standard to have the renewal or the new application take place on 1/1 of the following year. You can now apply or renew more on a rolling basis, but you have to get the application of the renewal in within 30 days of the first day of the start of each calendar quarter. So if you were to say apply today, December 16th, your private plan, if it gets approved, would not start until April 1 of 2026. You'd be under the public program for Q1 of next year because you missed that 30-day cutoff. Okay, so that's the amended regs, right? Just a little bit of change. If we go to the next slide, please. Claim administration process, big takeaway on this slide. It is different in Delaware than it is in a lot of other jurisdictions for PFML. The Delaware statute imposes a mandatory obligation that employers must approve or deny the PFML application for benefits within 5 business days of getting the completed application. That means the forms, that means that all the documentation, and if you're under the public program, the public plan through the state of Delaware, an advisory notice from the state. That's when the 5-day clock starts for the employer to complete the application. They can elect as an employer to go through the private plan or to opt out in favor of an approved, so you can use the public plan or opt out in favor of an approved private plan. That private plan would be through an insurance carrier or it could be self-administered. Either way, the employer can engage a third-party administrator to help with this process. For employers using the public plan, and if employers want, if you're going the private plan route, you can use the Delaware Labor First online system for managing Delaware PFML. It's a very lengthy process to getting these details in place, getting profiles and employee claim submissions, the advisory notice. How you apply and analyze the applications is through a reasonable person standard. There's also approval and denial notices that need to go out. It is a very involved process. So next slide, please. A couple more slides here. Firstly, notice and posting. You'll see that in order to get the contributions deducted from employee paychecks, you needed to give them a heads up at least 30 days before beginning those deductions. So a lot of companies started their deductions on January 1, 2025 because they gave notice of those deductions by December 1 of 2024. So if an employer has not yet started those deductions, know that that 30-day window needs to be satisfied and notice that time period. Employers also have to give notice to workers at the time of hiring and when they request or paid family leave or when the employer learns of the need for leave. There's a link to the model notice that's available here, and there is also a posting obligation that employers need to satisfy. Next slide, please. Finally, in terms of private plans, again, the employer can go the state public plan route or they can opt for the private plan. If they go the private plan route, there are multiple options. You can go through an approved insurance carrier through the state's Department of Insurance, or you can get approval for a self-insured plan. Generally speaking, you need to satisfy all the terms and conditions of the public plan. That includes not charging employees more than what the state plan would charge them. For the self-insured option, employers generally need to have at least 100 covered workers covered by the plan at all times. And again, to set up the private plan and go through the renewal process, Delaware Labor First is your ticket, is the mechanism you should be using. So with all of that, I will pass it over to Jean to talk us through Maine paid family medical leave, which is not far behind Minnesota and Delaware.
Thanks, Josh. Appreciate it. So I'm going to talk a little bit about the Maine paid family and medical leave, and we can go to the next slide for some dates. You can see this was passed in July 2023, and the Maine legislature was on top of getting contributions made even more than a year in advance of the program starting. So January 2025, payroll contributions began, and employers had to submit their first quarterly reports and contributions April 1, 2025. And benefits for this one don't start until May 1st of 2026. And so there may be some movement in between now and then, but we're going to just give you the landscape of where things stand now, and don't anticipate any, big changes like we saw in Delaware. So next slide, please. So I just wanted to kind of go over the basics. You can have either a private plan or a public option. In Maine, it pretty much covers almost all employers. There are some really limited exceptions like incarcerated people and work-study students and the federal government. But other than that, all employers are pretty much covered. The funding is a 50-50 split between employers and employees, and they have used a nice round number of 1% of wages as what the contribution amount is. However, there's no employer contribution if you have fewer than 15 employees. And so you can see here how you determine how many employees you have, but the employee contribution will still be made, but the employer doesn't have to contribute. Eligibility for leave is based on financial earnings. There's no tenure requirement. Employees don't have to have worked for you for a certain amount of time to be eligible. They just have to meet this earnings requirement. And you can see the benefit amount. It's a percentage of the average weekly wage in Maine. And for until July 1st, it's going to be $11.98. So Maine adjusts its average weekly wage as of July 1st. So the maximum amount is likely to change on July 1st. So will only be this amount for a short period of time. Notice, do have to provide notice to new hires within 30 days. That's going to be a customized form, but we do expect that the Maine Paid Leave Authority will come out with a template you can use. And there is also a posting requirement, and that poster is currently available and linked on the slide. So next slide, please. So reasons of use and duration. So the Maine law, unlike Delaware, is actually not very complicated. It tracks the FMLA almost exactly. The reasons for leave are identical to the FMLA, except that they have also added a safe leave reason. So for situations involving domestic violence, sexual assault, or stalking. But other than that, it's the reasons that we're all familiar with and are listed here on the slides. And just like the FMLA, it's 12 weeks of leave in a 12-month period. And that leave is going to begin on the Sunday prior to when leave starts. That'll be familiar to a lot of folks who are in other states that have these programs. And that's because it's a lot of these states are leveraging the unemployment systems to do this. And that's how unemployment tracks weeks of benefits. It will run concurrently with other forms of leave. And so that's helpful. And one thing that the Maine statute also does is that if somebody takes leave in the year before the statute goes into effect, that leave is going to count towards how much Maine paid family and medical leave they're eligible for. So if you have somebody who in February takes 2 months of leave, that FMLA leave, that leave is going to reduce what they're eligible for under the Maine program going forward. So that's kind of unusual. I don't know that we've seen that in so many other statutes. Usually whatever the date the law begins, that's when eligibility begins, but they this is a pro-employer point here in terms of how much leave will be available. And so the next slide. So the private plans, you have to submit an application to the Maine PFML Benefits Authority. And as with all these other plans, you have to provide equivalent benefits. You can offer either a fully insured plan or self-insured. Self-insured plans will require a surety bond to be filed or to be paid. If approved, these plans are valid for 3 years, which is nice. There are some states where you have to reapply every year. So this is nice. People only, or employers will only have to apply every 3 years. And there's the effective date stuff is here. So similar to what Josh was saying, you have to apply ahead of time, and it's going to matter where in the quarter you apply. So Maine gives you a little bit more time as long as you don't submit it in the last 30 days of the quarter. It can go retroactive to the first day of the quarter, but otherwise you have to wait until the following quarter. And then applications for the private plan have to be renewed 30 days before they expired, but the authority will give employers 60 days notice of that. So next slide. Leave can be used either in one block at a time, intermittently, or on a reduced leave schedule, similar to the FMLA. And then increments of use. So you can require that employees use this in 1-day increments. But if you have somebody who's also on FMLA, they are going to be entitled to use that leave in smaller increments. So, you know, usually a 1-hour increment. And so, you know, you can agree in writing to a smaller increment, or you may have to allow a smaller increment because of concurrent leave, but that can't be less than 1 hour. And then in terms of intermittent leave, you can have, an employer can have a reporting policy that they ask employees to follow, but employees will have to let the Maine authority know within 15 days that they've used intermittent leave. So the next slide. Employee notice to the employer. So employees have to provide notice, and it says they have to provide reasonable notice, which the rules say 30 days written notice is going to be presumed to be reasonable. And they do require written notice, which is not the case with some of these laws. And so you can require written notice, but you can't require it on a specific form. So as long as the employee gives you sufficient information that you can know that they're asking for the leave, that'll be considered sufficient. They do have to indicate the reason for leave, meaning is it family leave, medical leave, what's the reason they're taking it, how they want to take it, continuous, reduced schedule, or intermittent, and how long they anticipate the leave is going to last. Obviously, if it's a sudden illness or not foreseeable, then notice just needs to be made as soon as it is feasible. Excuse me. In terms of being able to apply for leave, if the public option is being used, employees can apply 60 days in advance, and they have to apply within 90 days of leave beginning. There is a exception for good reason, but 90 days is a pretty long time after a leave starts to give employees an opportunity to apply. So that really shouldn't be an issue in most cases. Next slide. So this is the one issue in Maine that is very different than any other leave statute that we typically see. And that is that there is this undue hardship provision. And one of the things to keep in mind is that undue hardship is not like it is under the ADA when you're looking at making leave, leave as a reasonable accommodation. If there's an undue hardship, you don't have to give the leave. Here, the leave has to be given. It's just the timing of the leave that you can assert as an undue hardship. And you can see the standard here. If employers want to take advantage of this, they do have to provide a written explanation to the employee demonstrating, how the specific employee's absence and the timing and duration of the requested leave is going to cause a significant impact on business operations or a significant expense. In order for undue hardship to be considered reasonable, and therefore the authority allows you to do it, the employee has to retain the right to take the leave within a reasonable time frame. And employers should be working with employees to come up with an alternative schedule for whatever the leave is. Obviously, some leaves can't be moved. Certainly, if somebody needs leave for a health reason, it has to be consistent with what their healthcare provider is saying they need in terms of timing. So once you're notified that an application has been filed, employers have 10 days in which they can notify the employee and the authority that they believe there's an undue hardship. You can also waive the undue hardship. If you're going to allow the leave, there's going to be a mechanism to waive that so that the 10 business days doesn't have to run before the paid leave authority can process the application. Next slide. So this is just applying for leave, and I'll just leave this up here. You all can see it's a pretty. I think we don't have as many details on this yet, but there is a fair amount, and you can read through that here. There is a waiting period for benefits, but it applies only to medical leave. That's a 7-day waiting period. And then we'll just go to the next slide, as I know that I'm running low on time. So coordination with other paid leave benefits. So this is similar to a lot of laws as well. Unemployment, workers' comp, Social Security, those types of things will reduce mass PFML, but other things like short-term disability, an employer salary continuation, or paid time off that's used to supplement or top up the benefit won't reduce PFML. Now, an STD plan can still say that it's going to be reduced by the amount of PFML that is paid, but those payments aren't going to reduce the actual payment to the employee. And you can't require folks to use their paid time off, but you have to allow it if they choose to do so. Next slide. And then job protection is only if the employee has been employed with you for 120 consecutive days. And then they just have to be restored to the same or equivalent position. And then effect on leave and other benefits. This is pretty standard. You have to continue health insurance. But the one thing to be aware of is that right now the law says that you have to treat people as if they are still employed. And that means that they should still accrue sick time and vacation PTO while they're on leave, which is a pretty unusual provision. And so we're kind of hoping that we might see some movement on that. But right now, that's what the law requires. And then I just want to turn to Rhode Island very quickly. There was just a two small changes to the Rhode Island temporary caregivers insurance, and you can go to the next slide. Those changes are effective January 1, increase of the number of weeks from 7 weeks to 8 weeks in a 12-month period. And they've added bone marrow donation and organ donor transplant. Those are not 8 weeks, it's 5 business days for bone marrow and 30 for organ donor. And I am going to turn it now over to Renata.
Thank you, Jean. Hello, everyone. We will turn our attention to Colorado for the next several minutes. This program has been active for a couple of years. If we go on to the next slide, we've got some, brief dates in here. The payroll contributions began in 2023. Benefits have been available for employees to use in 2024. And we are highlighting Colorado today because this law was amended back in May of this year under Senate Bill 25-144, with changes going into effect in a couple of weeks at the beginning of 2026. The next slide has a reminder of just some of the basics of the Colorado paid family and medical leave law. As is the case with many paid family and medical leave laws, there are very broad employer coverage standards in Colorado. Generally, this applies to all employers with at least one employee in Colorado, with the exception of the federal government. To be eligible for Colorado paid family and medical leave, employees simply must have earned at least $2,500 in covered wages during their base period or alternative base period, which is essentially 4 of the last 5 completed calendar quarters. And the wages do not necessarily have to be earned with their current employer. There's no usage waiting period under this law. And when employees take leave, they have job protection if they have at least 180 days of employment with their current employer prior to the commencement of the leave. Notably, the 180 days of employment do not need to be consecutive. It includes days off and periods of leave, so long as the employer reasonably believes that the employee will return to work. However, if the gap in employment exceeds 365 days, then the clock would reset to 0. Now, there is an exception for employees who are on military leave. Those folks are considered to be continuously employed. Because the legal standard for job protection is that an employee must have at least 180 days of employment prior to commencement of the leave, the rules inform us that if the employee takes leave continuously and they did not have their 180 days of employment prior to the first day of leave, then they're not covered by the job protection provisions. On the other hand, if the employee takes leave intermittently or on a reduced schedule basis, their leave is considered to commence upon each covered absence. And so in that case, they could potentially become eligible for job protection during their intermittent leave, even if they were not eligible on their first intermittent absence. Now, that said, even where there is not formal job protection under these, family and medical leave laws, terminating an employee who's taken this kind of leave can certainly be very risky with interference claims and protections under those sorts of laws and other things. Employers can comply with this law using either a public or a private plan, the public plan being administered by the state. And like most paid family and medical leave laws, there are notice and posting requirements in Colorado. Employers are required to post a program notice in a prominent location in the workplace, and they must provide written notice to each employee upon hire and upon learning of an employee experiencing an event that triggers eligibility within 5 days of learning of the event or receiving a request for leave from the employee. And this is important because if an employer fails to post or deliver the program notice, then they cannot discipline an employee for failing to provide notice to the employer of their need for leave. We move on to the next slide. We'll take a quick look at the funding mechanism and the benefits that are available to employees. So in Colorado, the paid family and medical leave program is funded through a combination of employer and employee contributions. Through the end of this year, the premium contribution rate is 0.9% of an employee's wages up to the Social Security taxable wage base. Beginning in 2026, this is decreasing to 0.88% of an employee's wages. Of course, with the Social Security taxable wage base increasing, the total contributions for your highest income earners might actually still increase next year. Moving into 2027 and beyond, the contribution rates will be set by the state on an annual basis in a way so as to ensure that the balance of the fund covers at least 6 months worth of the projected expenditures and the volatility of the premium rates are minimized. And in any case, the premium amounts will not exceed 1.2% of employees' wages. Premium contributions are generally split 50-50 between employers and employees, but employers with fewer than 10 employees are not required to pay the employer share. They are still required to collect the payroll deductions and remit those premiums to the state, though. The benefit amount that an employee collects is calculated using a formula based on the employee's average weekly wage, and essentially that's capped at 90% of the state average weekly wage. So right now, as of July 1st, 2025, and as we move into the first part of 2026, the maximum weekly benefit amount is $1,381.45. If we move on to the next slide, we have had some changes to the reasons for use. We've got the typical PFML reasons that we are accustomed to seeing, but as of January 1st, Colorado is becoming the first state where employees can use their paid family and medical leave benefits specifically if their child is receiving inpatient care in a neonatal intensive care unit. The regulations define neonatal intensive care unit as a hospital-based unit designated by the inpatient facility as a neonatal intensive care unit and equipped to provide continuous specialized medical care for critically ill or medically fragile infants. It includes well baby nurseries, pediatric intensive care units, and any other inpatient setting not classified explicitly by the treating facility as a neonatal intensive care unit, except that it does include other intensive care units into which the infant was transferred directly after the birth or from the unit classified as a neonatal intensive care unit if the transfer was due to an escalation of the infant's medical needs. We move on to the next slide. We'll see the covered family members. In the interest of time, I'm going to skip through that quickly just because there have not been any changes to this. Moving to the next slide, you'll see the duration of the leave benefits. Typically, this is up to 12 weeks per application year. That can increase in the event of a serious health condition related to pregnancy or childbirth complications. Beginning January 1st, employees will also be entitled to an additional 12 weeks of NICU leave. And it's important to note that this is on top of the 12 or 16 weeks of other Colorado paid family and medical leave reasons for use. It is, however, limited to the duration that the infant is actually admitted to the NICU. The regulations confirm that employees can be eligible for this leave if they have a baby who is already in the NICU and or if they have already used Colorado paid family and medical leave to take care of their baby prior to this January 1st effective date. So, with today being December 16th, it's certainly possible that someone could be having a baby, right now. They will, go into the NICU and they could use their other Colorado paid family and medical leave for the next 2 weeks under the caring for a family member with a serious health condition or bonding with a new baby, but then switch over to the NICU leave beginning on January 1st. The regulations also clarify for us that NICU benefits are not impacted by a subsequent separation from employment, even if the NICU leave is taken intermittently. And that's a departure from other types of intermittent leave under the Colorado paid family and medical leave. Generally, intermittent leave benefits cease if an individual becomes unemployed. However, claimants still cannot collect both unemployment benefits and Colorado paid family and medical leave at the same time. And finally, from a practical perspective, with NICU leave being treated as a separate entitlement, employers will want to consider how they're going to coordinate their company-provided benefit programs like paid parental bonding leave with NICU leave. While this NICU leave is a new entitlement, in reality, employees have been taking paid family and medical leave during periods when their infants have been in the NICU as either leave to care for a family member with a serious health condition or a bonding leave. Prior to this new law or new amendment going into effect. And most employer-provided benefits, which commonly provide for, a top-up of state benefits so employees can receive up to 100% of their normal pay, are not going to specifically address NICU leave like this. So you'll want to take a look at those policies. The next slide just has a quick reminder of how coordination of Colorado paid family and medical leave works with other paid leave and benefits. And I will just note that the regulations confirm for us that employers can require employees to exhaust their Colorado paid family and medical leave benefits as a condition of being able to access employer-provided benefits under disability plans or separate banks of paid leave that are available only for Colorado paid family and medical leave purposes such as parental bonding leave. And of course, employees can choose to use their accrued paid time off to top up their PFML benefits up to 100% pay. Shifting gears and moving a little farther out west, we'll spend just a few minutes talking about Washington paid family and medical leave. The next slide has some key dates. This program obviously has been on the books for quite a while, but we do have some amendments coming online January 1st. Moving on to the next slide, we can breeze through pretty quickly because there really haven't been any changes to these basics. It's very, broad employer and employee coverage standards. There are private and public plan options for compliance. There are notice and posting requirements under this law as well. On the next slide, we'll touch briefly on the usage waiting period. So for leaves related to family or employee medical leave reason, there's a waiting period of 7 consecutive calendar days before benefits are payable. This begins on the Sunday of the first week that the employee takes paid family and medical leave, and currently that's triggered when an employee takes a minimum of 8 consecutive hours. Now, this is one of the changes from the recent amendments. Because the minimum claim duration is being decreased from 8 hours to 4 hours, beginning January 1st, the period will be triggered when an employee takes 4 consecutive hours of leave. And then there's no usage waiting period if the leave is due to the birth or placement of a child or for a qualifying exigency. Moving on to the next slide, we've just got some quick updates in terms of funding and benefits. The premium rates are increasing to 1.13% of gross wages up to the taxable wage base. There's been some slight adjustment in the employer versus employee contributions. And as a reminder, employers with fewer than 50 employees in Washington are not required to pay the employer portion. The maximum benefit amount is increasing to $1,647 for 2026. Moving on to the next slide, you can see the reasons for use in covered family members. There have been no changes here. The next slide takes us onto the duration of the leave. And I do want to highlight again that reduced claim duration for 2026, moving from 8 hours to 4 hours in order to file a claim. And those can be for spanning, more than one shift, 2 hours at the end of one shift, 2 hours at the beginning of the next. The last slide two more slides I want to touch on. The next one is job protection. This is the most significant change under the amendments. So right now, job protection provisions apply only to employers with at least 50 employees. The employee has to have worked for the employer for at least 12 months and 1,250 hours during the 12 months prior to taking the leave. It's similar to federal FMLA. Beginning January 1st, the job protection provisions are going to be expanded. We're reducing the length of service requirement to 180 days. We're eliminating that 1,250 hour minimum hours worked requirement for job protection, and then expanding the job protection requirements for employers with fewer than 50 employees gradually over the next 3 years. Moving to the last slide about Washington, just some additional impacts of these amendments. Employers will now have a mechanism where they can count qualifying FMLA, federal FMLA leave, toward that job protection requirement. This essentially closes a loophole that previously allowed employees to stack their FMLA and Washington paid family and medical leave. There are some requirements to provide written notice if you are going to be leveraging that option. And that has to be provided to employees the earlier of 5 days after the employee requests or uses FMLA leave, and then on an ongoing basis each month for the FMLA period. Employers also must provide a notice to employees regarding their reinstatement rights and their return to work date, and then employees will have to affirmatively exercise their right to reinstatement by reporting to work on their first scheduled work day after their leave, unless a CBA or another employment agreement says otherwise. Finally, the amendments eliminated the requirements that Washington paid family and medical leave must have at least 1 day of overlap with FMLA for purposes of benefit continuation. And so accordingly, employers will be required to continue benefits during any PFML period unless the employee is no longer employed or the employee is not entitled to job protection. I think the next slide has our CLE code. For those of you who are looking for CLE credit today, you can scan the QR code, and the attendance verification code is on the slide, but it is SS as in Seyfarth Shaw 3005. Again, that is SS 3005. Once we've had an opportunity to get that QR code scanned, I will pass the mic back to Josh.
Thanks, Renata. Very good. So lots of ground, lots of updates. We want to go to the next slide, please, and then go one more from there. So we've included this slide for folks to the extent we've gotten confirmation on the 2026 reporting out on the maximum weekly benefits for different jurisdictions. We've touched on a couple of these today, like Colorado and Washington. Other jurisdictions you can see what some of those changes look like here as well for folks. So you can see the increases in places like Connecticut, Massachusetts, New York, and the like. There are a few jurisdictions, California, we're still waiting on confirmation for their increase. We have seen it look like it's jumping up into the 1,700 and change range. We're waiting to confirm that through the state and their websites as well. If you go to the next slide, one of the topics that we get asked about very regularly is to peek around the corner, look through our crystal ball, what's coming around the pike. And I think of the locations listed in that bottom bullet point, besides Maryland, right? Everybody, hopefully most folks here know that Maryland has a PFML program that was supposed to have started already, was delayed multiple times, and now looks like it's going to be starting in early 2028. Besides Maryland's program, where could PFML be coming next? Virginia looks the most probable of these jurisdictions. For each of the last 2 years, Governor Youngkin has vetoed a piece of legislation, a mandatory PFML legislation that has been approved by the full legislature in the state of Virginia. Governor Youngkin was termed out. His replacement is of the opposite party, and it seems possible, if not even possible, maybe probable, that Virginia will take another big swing at PFML this current upcoming legislative cycle. So keep an eye on Virginia, as well as places like New Mexico and Hawaii, which have commissioned studies on PFML. Places like Nevada, which came close to passing a PFML law during the 2025 cycle as well. So definitely worth keeping an eye on each of those states heading into 2026, but Virginia being the one that should top your notice list. Next slide, please. From a federal perspective, there was a lot of activity in 2025, even though nothing major by way of new federal paid leave mandates, nothing like that, certainly, but baby steps forward. We'll spend some more time talking about these in one of our 2026 webinars, but you had in late April both HR 3090 and HR 3089, the I-Plan Act and the More Paid Leave for More Americans Act were both introduced in the House of Representatives. Those are important steps forward, specifically the I-Plan Act for the coordination and harmonization that it would look to seek across existing PFML states. There was also a change to the 45S paid family medical leave tax credit through HR 1 this past summer, which should allow more employers to take advantage of this tax credit. So if you are an employer who has not paid attention to this tax credit, we have a wonderful team of tax attorneys here at Seyfarth who myself and some of our leave colleagues have partnered with to advise clients on whether they can take advantage of this tax credit. And it's rare that we can give good advice to companies to save some money in the paid leave space. So this is one of those ways. So certainly worth thinking about if you have not looked under those rocks in the past. Finally, if you go to the next slide, and one more, please, we have plenty of resources available, complimentary for the most part. Our paid leave mailing list is available there to sign up sheet for you. You can also reach out to us at paidleave@seyfarth.com for information on our comprehensive paid family medical leave law survey that we have that covers every one of the laws we've touched on today, as well as all the ones that we mentioned very briefly at the beginning and end of the presentation. On the next slide, we also have this webinar series and its prior 10 parts, as well as today's segment, a separate series on paid sick leave, which the next segment of that webinar series will be this coming Thursday. And we also have a podcast on leaves and accommodations called Take It or Leave It, that we have plenty of episodes that are focused on the paid family leave topic and related subtopics like parental leave and the like. So with that, thank you everyone for joining us. We've responded to a number of the questions in the chat. If we didn't get to your questions, do feel free to reach out to us on here on our thank you slide. So thank you so much, everyone. We appreciate your time. Again, happy holidays. I look forward to seeing you in the new year.